Okay, good evening, everyone. I hope you're doing good. So I can already see a lot of students already into the systems. So we have Jaidev, Keshav, Kiran, Darshan, Sudhanshu, Rajiv Kumar, Diksha, Manisha, Kiran. Good evening. Very good evening, everyone. Uh, Today's class of ours is about the revision of the two topics that we have done, which is about the ratio analysis and the capital structure, right? So we'll do some questions in this today's session. I'll take up if any doubts you have. And of course, we'll be doing questions from the past question papers from MTP, RTP, and if any study material question, if you guys wish to propagate the same. Okay. So to begin with, let's just get started with one of the questions from the recent RTP question, from the recent RTP. The RTP that was relevant for the ongoing exams, or rather that is relevant for the ongoing exams. So from here we can say, from the following information, we have to find out the missing figures and rewrite the balance sheet of Mukesh Enterprise. We have to rewrite the balance sheet of Mukesh Enterprise. Current ratio is uh, given 2:1. Asset test ratio is given 3:2. Reserves and surplus is 20% of equity share capital. Long-term debt is given as 45% of net worth. Stock turnover velocity is 1.5 months. Receivables turnover velocity is 2 months. We are going to assume receivables as average receivables, and gross profit ratio will be 20%. Sales is given as 21 lakh, of which we are saying 25% sales are on cash basis. Okay. And balance is on the credit basis. Closing stock is 40,000, more than the opening stock. And we have accumulated depreciation is 1/6 of the original cost of fixed assets. Balance sheet is given as follows. So we have long-term loans figure and bank overdraft. Rest all things are unknown to us. So we have to solve this. Uh, let's get started with it about how do we approach this typical solution, or the solution to this typical answer. Okay. So as I've told you in the previous class also, always look for the ratios which are connected with some numbers. Okay. So always look for ratios which are connected with some numbers. So if we have current ratio, check out if we have some number of, related to working capital. Current ratio 2:1. Asset test ratio is 3:2. In related to that, we don't have any other number, but the only number that we have is the sales figure. Well, the sales figure is, guys, 21 lakh, of which 25% is on cash and balance on credit basis. So using sales, we can also look at this GP ratio is having. We have the GP ratio as 20%. So essentially, what I can say is sales is 21 lakh and GP is 20%. So from that, we can get COGS, and in turn, COGS will help us in getting the numbers for the stock. Similarly, depreciation is going to be for fixed assets. From sales, we should also know that we are going to get the receivables figure. Once we have the COGS, we can also consider the calculation of the creditors. So the whole calculation actually revolves around this sales figure. So let's just get started with this question. Okay, so I'll just place the question over here for our reference. We can refer back again and again. Current ratio, asset test ratio is of no use as of now. As of now, the only thing that is relevant for us is the sales figure and the gross profit figure. So let's get started with it. So we are solving this question of RTP May 2023, question number 1. Okay, guys. Right. So let's look at the sales figure. Well, sales is given to us to be of 21 lakh. Sales amount is of 21 lakh, right? Now this sales figure is also going to give me the COGS figure. From this sales, we will definitely say that there are some component as credit sales and cash sales. So the question says that credit sales, cash sales is 25% of the total, and the balance is on the credit sales. So we can simply say that cash sales is 25% and credit sales is 75%. So credit sales will work out to be 21 lakh, 75%. So 21 lakh into 75%, which is 15 lakh 75,000. And the cash sales is going to be the balance, which is 5 lakh 25,000. Correct? So here we have these numbers, sales and the sales, credit sales and the cash sales. Now from this, GP is given, so we can get the gross profit number. So gross profit is basically 20%. So since the GP ratio is 20%, that will be 20% of the sales figure. So gross profit is 21 lakh into 20%. So 21 lakh into 20%, which is 4 lakh 20,000 is the GP. And accordingly, our cost of goods sold will be 21 lakh minus 4 lakh 20,000 of gross profit. Right? So which is translating to 16 lakh 80,000 is the COGS. Okay. Now we can go for the further calculations now. Receivables turnover velocity is 2 months. Stock turnover velocity is 1.5 months. Now to get the stock turnover, we need to get the stock turnover thing. I have this calculation like this, yeah. Stock velocity or stock holding period, basically. We know stock holding period is average stock upon COGS into what is the parameter on which it is measured in terms of months. So stock turnover is 1.5 months, so into 12. So we have the average stock upon COGS will be 16 lakh 80,000 into 12, which is equal to 1.5 months, correct? So from this, we can actually get the average stock figure, guys. From this, we can get the average stock figure. So average stock will be 16 lakh 80,000 into 1.5 by 12. Right? So 16 lakh 80,000 into 1.5 divided by 12, which is 2 lakh 10,000. So this is the 2 lakh 10,000, the average stock. But the question is giving information that closing stock is 40,000 more than opening stock. So I need to get the figures of closing and opening. So this average stock actually is answer for opening stock plus closing stock divided by 2. So we get opening plus closing as 4 lakh 20,000. So this is one of the equations we get. Let me just name it as equation number 1. Opening plus closing is 4 lakh 20,000. But there is another information which says closing stock is 40,000 more than opening stock. The closing is 40,000 more than opening stock. So closing minus opening is 40,000. Closing stock minus opening stock is 40,000. So closing stock is more than opening stock by 40,000. So we take that into account, and this is the second equation. And we know guys how to solve this sort of equations, right? We can simply solve this as taking a difference, and this, if we take a difference, we can just say the opening, or not difference actually, add them both. To add both the equations, you will find that opening and minus opening gets cancelled, and you have 2 times of closing stock as 4,60,000. So simply speaking, closing stock will work out to be 2,30,000. Therefore, opening stock, guys, it's going to be 2,30,000. Closing is more than opening by 10,000. So it's going to be 2,30,000 minus 10,000, which is 2,20,000. So that's your opening stock. So we have the closing stock figure. We have the opening stock figure. Now, from this credit sales figure, remember we can get the amount of debtors also. Receivables turnover velocity basically, which is 2.5 months. And sorry, it's 2 months. And they're saying closing and average receivables are one and the same. So if we talk of receivables collection period, receivables collection period. Receivables collection period. Difference is 40,000. Okay, Himanshu, right? So the opening stock is going to be lesser by 40,000, right? Correct. This is minus 40,000. So opening will be 1,90,000, correct? Opening will be 1,90,000. Correct? I hope. Diksha, Himanshu. Yeah. Receivables collection. Receivables collection period, we know it is computed as average receivables upon credit sales. Average receivables upon credit sales into 12. So therefore, we say that average receivables amount, what we need to compute, upon credit sales is 15,75,000 into 12 is equal to how many months is the receivables turnover? That's two months. So we get the average receivables. The average receivables figure will be 15,75,000 into 2 by 12. Right? So 15,75,000 into 2 divided by 12. 1 second, 15,75,000 into 2 divided by 12. That gives us 2,62,500. And this itself is going to be your closing receivables. This itself will be closing receivables of 2,62,500. Okay. Now, can we go ahead with some more ratios, some other ratios? Well, then we have stock turnover is done, receivables is done. Now we just have to look at, like, we have got some amount of creditors and bank overdraft is also there. It's already given. Now we have to look at these ratios, current ratio and acid test ratio. So let's try to work out with the other aspects. First, we have this current ratio number. Current ratio is given as 2:1 and acid test ratio is 3:2. So current ratio, we know it is current asset upon current liability, which is 2/1. Therefore, current asset is 2 times of current liability. Okay. We have acid test ratio. Acid test ratio, what we do is we say it is current asset minus stock upon current assets minus stock upon current liability. So this is given as current asset minus, we have computed the stock figure, right? The closing stock figure, which is 2,30,000. So current assets minus 2,30,000 upon current liability is equal to, what's the acid test ratio given? 3:2. Or we can say 2 current assets minus 4,60,000 is equal to 3 times of current liability. Correct? So I'll just substitute this current asset in this equation. So this becomes 2 times of 2 current liability minus 4,60,000 is equal to 3 times of current liability. We have 4 times of current liability minus 3 times of current liability is 4,60,000. And that actually makes it as, we have the current liability figure as 4,60,000, right? But since we are having already a bank overdraft value of 60,000, we can say current liability is bank OD plus creditors. Bank OD plus creditors. So current liability is 4,60,000. We have a bank OD of 60,000 given in the question. So of course, the balancing figure that we have is the creditors, and therefore we get the value of creditors to be 4 lakh. Okay, so finally we have got the value of stock, we have got the value of creditors also, and we also have the value of debtors. Now, once we get this current liability of 4,60,000, I can actually get, since current asset is 2 times of current liability, therefore current asset figure will be 2 into 4,60,000, which makes the current asset as 9,20,000. Now, current assets, what does it include? It includes the stock, it includes the debtors, plus also includes the cash balance. So we have stock value with us. The closing stock figure is 2,30,000. This is 9,20,000 current assets is equal to closing stock of, we have computed closing stock to be 2,30,000 plus debtors. We have also computed the debtors or the receivables. Closing receivables is 2,62,500. plus 2,62,500, and then plus we also have the cash balance. So of course the balancing figure will work out to be the cash, and cash will be like 9,20,000 minus 2,30,000 minus 2,62,500, which is cash is a balancing figure 4,27,500. So what all we are done? We're done with creditors, we're done with stock, debtors, cash. Now we have the other things. One is the equity share capital, reserves and surplus, fixed assets, and then accumulated depreciation. So let's look at the other ratios. Reserves and surplus is 20% of equity share capital. So this is dependent on this. We'll get back to it later. Long-term debt is 45% of net worth. Okay, so this long-term debt is 45% of net worth. We can have a formula. Long-term debt is 45% of net worth. So long-term debt is anyways given as 6,75,000. So that 6,75,000 is 45% of net worth. That simply means net worth is 6,75,000 divided by 45%. So we have net worth as 6,75,000 divided by 45%, which is net worth works out to be 15 lakhs. Net worth is 15 lakhs. Now, if you look at the other thing, net worth is 50 lakh, but we have this reserves and surplus as 20% of equity share capital. So I need to break this net worth into two portions. One is the equity share capital and the reserves and surplus. So regarding that, we have the reserves and surplus to be 20% of equity share capital. So if I take let equity share capital is equal to rupees X. Therefore, reserves and surplus will be 20% of equity share capital, so which is 0.2x. So this total works out to be 1.2x, which is the net worth figure. So we'll say therefore 1.2x is 15 lakhs. And therefore, the value of x will work out to be 15 lakhs divided by 1.2, which is 12,50,000. Right? So what have we taken x as? We have taken equity share capital to be x. So we can say, therefore, equity share capital is 12,50,000, and reserves and surplus will be 12,50,000 into 20%, which is 2,50,000. Equity share capital, reserves and surplus. We got it. These two figures. Now the only thing left out is the fixed assets. And with regards to fixed assets, do they have any other information? Accumulated depreciation is just given, whereas the rest all things is like it's the normal thing. So let's try to prepare a pro forma balance sheet and then try to find out the fixed asset to be the balancing figure. We have the gross block, then the accumulated depreciation, and then the net block. You have stock, debtors, and cash. Stock, debtors, and cash. And then we have equity share capital, reserves and surplus, long-term debt, creditors, and bank holding. So we have the stock figure available with us. Closing stock was 2,30,000. right? Then we had the value of debtors. Debtors was 2,62,500. Even cash is calculated as 4,27,500. And on this side, we have the net worth, where equity share capital is 12,50,000. Reserves and surplus is 2,50,000, right? Long-term debt, that's given to us 6,75,000. Overdraft is 60,000 and creditors is 4 lakh. Yeah. So you can simply get this net block to be a balancing figure for this balance sheet. So the balance sheet totals at 12,50,000 plus 2,50,000 plus 6,75,000 plus 60,000 plus, so it totals at 26,35,000. And from that, we will subtract 2,30,000 of stock, 2,62,500 of debtors, 4,27,500 of cash. So this works out to be 17,15,000. And we say that the accumulated depreciation is 1/6 of the original cost. So if this is 1, if gross block is 1, accumulated depreciation is 1/6. So this is basically 5/6. Right? So if this is 5/6, then we need to simply do the cross multiplication. This is like 6 divided by 5. 20,58,000 is the gross block. And then you have 3,43,000 to be the accumulated depreciation. And you have 20,58,000 minus 3,43,000. So 17,15,000 as the net block. This is the final balance sheet that we have to solve in the given question. I hope this is easy for you guys. Were you guys able to solve it? Were you able to solve this, guys? Are you following this? Yep. Are we following this, guys? Yes. Nice. It's easy. Fantastic, guys. So here we have this uh, question wherein we had this question on ratio analysis. Now let's try to look at one of such questions in the mock test paper. Look at this question, guys. This question in the past, one of the mock test papers, we have this question. Let me just copy it in my main file so that you'll be able to access it easily. Okay, look at this question. Fixed assets turnover ratio is given as 10 times. Capital turnover ratio is 3 times. Inventory turnover is given as 10 times. Receivables turnover is 5 times. Payable turnover is 5 times. GP ratio is 40%. And gross profit during the year amounts to 15 lakhs. There is no long-term loan or overdraft. Reserves and surplus amounts to 5 lakh. Ending inventory is 40,000 above the beginning inventory. Now fixed asset turnover, this is 10 times. So now this question has come for 5 marks in the exam. So I want you guys to try to solve this within a timer of, you know, you should be able to solve it roughly without much solving, without much proper presentation. You should be able to crack it within next 5 minutes. So as I do, I'll set a timer for you. So the time starts now. You have to solve it within 5 minutes, guys. And here the time goes. Come on. Let's begin, guys. Try to solve it within 5 minutes. In rough, I don't want you to do it, in sort of fair thing. Try to solve it in rough and at least try to get the idea. Yeah, so here we have the timer. The timer is set for the next 5 minutes, guys. You have to prepare the balance sheet, find out the assets and liabilities. In this question, you have to find out the assets and liabilities. Yashika, I think I have made the adjustments for the screen. You can look at now all the figures are on the screen. So I have adjusted that top portion. Yeah, come on, quick guys. Try to solve it very quickly in a rough way. If you're able to solve it in rough in 5 minutes, I'm pretty sure you can solve it in fair in the next 10 minutes also. Okay, so timer is up. Were we able to crack it? I don't know. Hmm. Let's try to solve it. Uh, Generally, students get confused as to how do we solve this type of questions because everything is given in terms of times and we don't have any numbers. For that, you just need to look down. Look over here, we have the GP as 15 lakh. There's no long-term loan or overdraft reserve and surplus amounts to 5 lakh is given. Ending inventory is 40,000 above the beginning inventory. So since we have the GP and also the GP percentage, we can easily get the sales value and the COGS value, right? Right. So we can say gross profit is 15 lakh, which is sales multiplied by 40%. So obviously the assumption over here we are going to have is all the sales and purchases are on purely on credit. So accordingly, we get the sales as 15 lakh divided by 40%. So sales is 15 lakh divided by 40%. Should get this as 37 lakh 50,000 as the sales figure. And this is fully credit sales. Now, since we have this sales, we can actually get the COGS also. COGS will be 37 lakh 50,000 into 60%. Is 22 lakh 50,000. Right. So COGS is 22 lakh 50,000. So based on COGS, inventory turnover, your receivables turnover, payable turnover, GP ratio is given. Now, since we have sales, we can get the receivables also. We know receivables turnover is sales divided by the receivables value. So receivables turnover is 5. So sales is 37 lakh 50,000 divided by receivables. We don't know, rather we'll get the value of the receivables from here. Therefore, receivables will be 37 lakh 50,000 divided by 5. 37 lakh 50,000 divided by 5. This amount is 7 lakh. Okay. So receivables amount works out to be 7 lakh 50,000. Okay. Receivables is done 7 lakh 50. Then for inventory turnover, we can use the COGS figure. Let's talk of inventory turnover. Inventory turnover is COGS upon inventory. The inventory turnover amount is inventory turnover number is 10. So 10 is equal to COGS is 22 lakh 50. 22 lakh 50 divided by the inventory value. And obviously this is our average inventory. So we get average inventory to be 2 lakh 25,000. Now we know average inventory is opening stock plus closing stock of 2 lakh 25,000. And again in this question, we have the information that ending inventory is 40,000 above the beginning inventory. So basically we have closing stock minus opening stock to be 40,000. So if we just add them all, we can simply say opening and opening gets cancelled, and we have 2 times of closing stock is equal to 2,65,000. So the closing stock figure works out to be 2,65,000 divided by 2, which is 1,32,500. The closing stock is 1,32,500. And anyways, we need the balance sheet on the same lines. So that's done. Then we have inventory turnover, receivable turnover is done. Now payables turnover. For payables turnover, you have to be cautious because payables turnover is based on purchases, right? And we know COGS. By the way, we need to also get the opening, which will be 1,32,500 minus 40,000. We will have 1,32,500 minus 40,000, which is 92,500. So closing stock we have is 92,500. One second, there is a mistake, I think. Yeah. So this is opening plus closing. Divide by 2, right? These numbers are actually incorrect. Opening plus closing divide by 2 is this. So we get opening plus closing to be 4,50,000. And accordingly, my numbers are going to change. So 2 times of closing stock will be 4,90,000. And we get the closing stock figure to be 4,90,000 divided by 2, which is 2,45,000. Right, so 2,45,000, and then we'll have the opening stock to be 2,45,000 minus 40,000, which is 2,05,000. So closing stock 2,45,000, opening is 2,05,000. We know that COGS is actually computed as opening plus purchases less closing. So COGS figure we do have, which is 22,50,000, right? So COGS is 22,50,000, and that is equal to opening of 2,05,000 plus purchases minus closing of 2,45,000. So we get the figure of purchases. So purchases will amount to 22,50,000 minus 2,05,000 plus 2,45,000, which is 22,90,000. Now, based on these purchases, we can get the creditors. Based on these purchases, we can get the value of the creditors because the creditors turnover, payables turnover is 5 times. We have creditors turnover to be 5 times, and this 5 times is computed as purchases upon creditors, which is like 22,90,000 divided by the creditors. So creditors amount will be 4,58,000. So we have got the amount of creditors, we got the amount of stock, we have got the amount of the receivables. So we have utilized these ratios: CP ratio, payable turnover, receivable turnover, inventory turnover. Now we just have the capital turnover and fixed asset turnover ratio to be done. Let's do it. First up, fixed asset turnover ratio. Fixed asset turnover will be 10 times. But this fixed asset turnover is based on COGS, guys. So this 10 is actually COGS upon fixed assets, right? So COGS upon fixed assets. Now COGS figure we do have, we have computed the COGS as 22 lakh 50,000. So 22 lakh 50,000 divided by fixed asset, that will give us a fixed asset amount of 2 lakh 25,000. So we got the fixed assets also. Now the only ratio that is left out is the capital turnover, which is 3 times. And the question says there is no long-term overdraft and they have a reserves and surplus of 5 lakh. So we'll just say capital turnover, which is COGS upon capital. And this number is 3 times. We have the COGS as 22 lakh 50,000 upon a capital of 3. And therefore we say that capital employed will work out to be 22 lakh 50,000 divided by 3, which is 7 lakh 50,000. Okay, from that you can reduce the reserves. The question says that it has got a reserves of 5 lakh. So reserves are 5 lakh, and then you have the balance as the equity share capital, which is 2 lakh 50,000. So capital employed 7 lakh 50, less reserves of 5 lakh, and equity share capital is 2 lakh 50,000. Okay, so that's where we say this as equity share capital 2 lakh 50,000. So I think we are done with almost part of it, because then the question asks us to show the assets and liabilities. So if we just try to put up the balance sheet, we have computed the fixed assets to be 2 lakh 25,000. Equity share capital 2 lakh 50,000. Reserves of 5 lakh. And they say they don't have any debt or bank OD, nothing. So you just have the amount of creditors in your books. The creditors is 4 lakh 58,000. Then you have the stock and the debtors. So closing stock is 2 lakh 45,000. Closing stock is 2 lakh 45,000. And then you have the amount of debtors. What is the amount of debtors? I think we have computed the debtors. Receivables is 7 lakh 50. So is it 7 lakh 50 receivables? Yeah. Then no long-term debt or overdraft. Reserves and surplus is 5 lakh. I think we have got something wrong, or capital turnover is 3 based on COGS. So COGS was 22 lakh 50. So where are we going wrong? Look at this part C is a MTP. Second, let me just check. Are we going wrong? Is there some problem? I know. We go ahead. Purchases are 22 lakh 90. Creditors is 4 lakh 58. Okay. Second, the fixed asset turnover is 10 times based on COGS. So we get fixed assets of 2 lakh 25. Is it tallying? No, there is some problem. If you just try to tally it, it's not tallying, right? Because total is 2 lakh 25,000 plus 2 lakh 45,000 plus 7 lakh 50,000, which is 12 lakh 20,000. And on this side, you have 2 lakh 50,000 plus 5 lakh plus 4 lakh 58,000. So this side you have 12 lakh 8,000. Yeah, average inventory, you're getting it as 8 lakh 20. Closing stock is 8 lakh 20. How come? There seems to be a balancing figure. So which side is it? 2 lakh 50,000 plus 5 lakh plus 4 lakh 58,000. 12 lakh 8,000. We have 2 lakh 25,000 plus 2 lakh 45,000 plus 7 lakh 50,000. That's 12 lakh 20,000. So we still have some sort of balancing. There's a difference of 12,000. By the way, if you take creditors over here, 1 second, ending inventory, payables turnover is 5 times. If you take it on the basis of COGS, let's say COGS was how much? 22 lakh 50,000. And this divided by 5, this would have given 4 lakh 50. To reduce it further, rather, the purchases are bound to be 40,000 higher. So I don't know if there's any solution for this. Do we have it? Yeah, so there's this balancing figure. 12,000 is coming out to be a balancing on the credit side. So what can we say about this credit side balancing figure? This credit side balancing figure, what are we going to call it as? Because there doesn't seem to be any other reason that it's the case, because GP ratio was 40%. So we took the sales as 37 lakh 50, which is 15 divided by 0.4, 37 lakh 50. And on that, you can say 60% is supposed to be the COGS. We have it correct. Then we have the receivables. Reserves and surplus is 5 lakh. Ending inventory is given. Now receivables will be, of course, 37 lakh 50,000 divided by 5. 37.5 divided by 5, which is 7 lakh 50. Inventory will be COGS, so average inventory 225. You have 245 and 205. Okay. So purchases will be 22 lakh 90. 22.9 divided by 5. That's 4 lakh 58. And then you have the fixed assets also on the basis of COGS, right? Yeah, based on cost of sales. So based on cost of sales, you have the fixed asset figure as 2 lakh 25 and then COGS divided by 3. 22.5 divided by 3, which is 7 lakh 50, and you have the equity share capital. Okay. So Darshan, in the solution, there's a balancing figure comes on the debit side. Yeah, so I'm just looking at where have we gone wrong in the solution. I don't have access to the solution. I don't know. Do I have it or not? The MTP. That's the question. Okay. Where have we gone wrong? We need to check it. We got the sales to be correct, 30, or have I copied it incorrectly? Just see. 10 times, 3 times, 10 times, 5 times, 5 times, and 40 times. Gross profit for the year is 15 lakh, no long-term loan or overdraft. Reserves and surplus of 5 lakh. Ending inventory is 40,000 above the beginning inventory. So ending is 40,000 above. Ending is 40,000 above. So we have taken it on the similar lines. Where have we gone wrong? I'm really surprised. GP, that is COGS as 22 lakh 50. This is correct. Receivables turnover, the basis of this 7 lakh 50. So that is 5, right? Receivables turnover is 5 times. Payable turnover is also 5 times, and that is 10 times. So 22 lakh 50 divided by 10, 2 lakh 25. Correct. COGS, we get the purchases. Purchases figure. There's some mistake over here. 22 lakh 50,000 minus 2 lakh 5,000. 5,000 plus 2 lakh 45,000. Yeah, that's 22 lakh 90. Then 22 lakh 90 divided by 5, 4 lakh 58,000. Creditors is 4 lakh 58. Fixed asset turnover is given as 5 times, or fixed asset turnover is 10 times. Yeah, so fixed asset turnover, we get a fixed asset value of 2 lakh 25. Creditors of 4 lakh 48, 4 lakh 58. We have a stock of 2 lakh 45. Formula for creditors turnover is it different? We have the purchase upon creditors. I don't think there should be any difference in it. We need to check. Anyways, there's something going wrong over here. I need to check it. We'll check that in the break and try to correct that wherever it is. Anyways, let's now go for new question rather. We'll get into that question. Where are we really going wrong? Because ideally, there should be a balancing figure over here. Not sure where is it wrong. Need to check it. Capital employed. Everything seems to be correct. Anyways, not to waste much of our time onto it. Let's go for some new question from the RTP. Yeah. So we have this question of capital structure from the recent RTP. Let's try to discuss it. Current capital structure is as follows. Equity share capital is 7 lakh shares. Yashika has pointed out the answer. Opening stock is 92,500 and closing is 132. Well, Yashika, inventory turnover is 10 times, right? Inventory turnover is 10 times. So we get average inventory as 2,25,000. So opening plus closing divided by 2 will be 2,25,000. So that doesn't seem to be a thing. Second, let me see. Okay. We get the closing stock as 2,45,000 and payables we get in this. There is something payables 14,58,000. Solution seems to be a bit incorrect this time. 7 plus 2 plus 2, you have 12, and then 5 plus 4 plus 2. Yeah, I think there's a problem with this with the question itself, guys. The problem with the some minor error, I think, is there. Seven lakh 50 stock, 245 and 225, 255, and this is correct. So there is some problem in the question itself, guys. Anyways, let's not. The correct answer would be, to take it as other current liabilities over here, 12,000. Anyways, it is a turnover ratio formula is equal to creditor divided by the average accounts payable, average accounts means average creditors plus. No, Nikshita, you are totally wrong what you're interpreting. Okay. Anyways, let's look at this capital structure question now. Capital structure of XYZ is as follows. We have equity share capital 7 lakh shares of face value rupees 20 each. Reserves of 10 lakh, 9% bonds of 3 crores, 11% preference capital, 3 lakh shares of face value rupees 50 each. Additional funds required for XYZ are 5 crores. So additional funds that are required is 5 crore. XYZ Limited is evaluating the following alternatives. First proposal is to raise the funds by 25% equity and 75% debt at 10% P ratio. P ratio is going to be 12 over here. And in the second alternative, we are going to raise the funds 50% equity, the balance by 12% preference share capital, and P ratio. In that case, it would be 11. Any new equity capital would be issued at a face value of rupees 20 each, and any new preferential capital would be issued at a face value of rupees 20 each. Tax rate is 34. You have to determine the indifference point between both the alternatives. So we have to obtain a indifference point over here between the alternatives. Now, for getting the indifference point, we need to first list down the financial plans properly so that we can apply the formula. Equity share capital, 7 lakh shares of face value rupees 20 each. Reserves are given, 9% bonds are given. So this is the existing capital structure. And then these are the two proposed capital structure. So they'll say existing and then we have the proposal number 1 and proposal number 2. So in the existing, we have equity share capital. Equity share capital, 7 lakh shares of rupees 20 each. Face value is rupees 20 each. So 7 lakh into 20, that works out to be what? 7, 14, 1 crore 40 lakh. Right? We have 1 crore 40 lakh. The reserves are of 10 lakh. Reserves are of 10 lakh. 9% bonds are of 3 crores. Okay. And 11% preference shares. 11% preference share. They have 3 lakh shares of rupees 50 each. So that translates to 1 crore 50 lakh. Okay. The additional fund requirement is this 5 crore, and that 5 crore needs to be through proposals. So first proposal is raise the funds via 25% equity capital, 75% debt at 10% P, and in such scenario it will be 12. So 25% via equity share. Now any new capital, they're saying we are going to issue it at face value rupees 20 each. So in case of proposal 1, the equity share capital will be definitely 1 crore 40 lakh, whatever is existing. In addition to that, 1.4 crores. In addition to that, you are also going to have 25% equity capital, 25% of 5 crore. So 1.4 crores plus 5 crores into 25%. So basically 1.25 plus 1.4, which is 2 crores 65 lakh as equity share capital, and the balance 75% at 10% debt. A new type of debt will come up, which is 10% debt, which is 5 crore into 75%, which is 3 crore 75 lakh. Right. So proposed alternative, raise the funds via 25% equity capital and 75% debt at 10%. P ratio, that in that case it's going to be 12. Then in the second proposal, We have raised the funds 50% by equity capital. So it means in the proposal one, the existing reserves, 9% bonds, and 11% preference share capital will remain intact. Now, in the second proposal, raise the funds by 50% equity. It means already you have 1.4 crores plus 5 crores multiplied by 50%. You have 2 crore 50 lakhs plus 1 crore 40 lakhs. So 2 crore 50 lakhs plus 1 crore 40 lakhs, which is 3 crores 90 lakhs. Reserves will remain 10 lakh. 9% bonds will remain same 3 crores. 11% preference share capital will remain 1 crore because the new preference share capital are issued at 12% rate. Then you have 12% preference share capital. The balance 2 crore 50 lakh. So the total capital employed will remain same in both cases. The existing total capital is 1 crore 50 plus 1 crore 50. So this was 6 crores. And the new capital is going to be 11 crores. Okay, so these are the two things. Now we have to find out the indifference point. Now, do we find out the indifference point? We simply take the EPS. Right? We simply take the EPS of plan 1 to be equal to EPS of plan 2. So we just form an equation and get the answers for this. So if you look at the equation that's formed, one second, yeah. So EPS for the first plan, you can say interest for the first proposal, as we can find out. This is what we have already stated. Interest for the first proposal will be 3 crore multiplied by 9%, which is a debt, and also 3 crore 75 multiplied by 10%. So total 64 lakh 50,000. Preference dividend similarly for the proposal 1, for the first proposal, preference shares, you can say 1 crore 50 lakh into 11%. And similarly, you can do it for proposal 2. And we know that we just equate these two and get the value of X. That X will be working out to be 72 lakh 63,636. Now, this portion to get the EPS, we'll get this equations first. Yeah. Is the amount of EPS that we have. Now, we'll take a break, and within a break, I want you guys to solve these two equations, or I can say equate these two and get the value of X. We can look at the verify the answers once the break is over. So right now, let's take a break of 10 minutes, guys. After the break, we'll take up some more questions related to ratio and the capital structure. Let's take a break, guys. Okay. So welcome back, guys. After the break, I hope you might have solved this question. In the break, I've asked you to solve it simultaneously. I hope you're able to crack it, right? So it was just simply equating, and X value should be getting it as 72 lakh 63,636.36. Okay, fine. Let's take some more questions from the past RTP and MTPs, or maybe let's take a question itself. The November 22 paper. Let's try to solve a question from here. So this is not a question. This is a question which is based on ratio. And one more question we'll take up, which is based on this question 5A. Let's try to solve this question first. Let me just open it in the app. The following are the costs and the values of the firms A and B according to the traditional approach. So we have the total value of the firm with 50,000 and 60,000. A is an unlevered firm because it doesn't have any debt. B is a levered firm having a debt of 30,000, and market value of equity works out to be 50 and 30. Net operating income is 5,000 in both cases same. Cost of debt in rupee given. Net income is the balancing figure. Then we have a cost of equity, which is the net income divided by the value of equity. We have to compute the equilibrium value for firm A and B in accordance with the approach, assuming that the taxes do not exist, and the equilibrium value of KE is 9.09. Also compute the value of equity and cost of equity for both the firms. Okay. Himanshu is asking, sir, there are two more formulae on page number 5.16 for cost of equity in levered form and WACC in levered form. 5.16, is it a relevant chapter for us, or is it a chapter from cost of capital? Chapter 5. Is it? I think that's the cost of. Is it same as this? Okay, it's a financing decision after cost of capital. Okay, I'll do that, Himanshu. Once I complete this question, I'll definitely do that. Okay, fine. So let's look at this solution now. This question 5A. Yeah. So there are two firms which are given to us. Right. So two firms are given with their respective values. Now for first up, we need the equilibrium value as per the approach. Equilibrium value as per the approach. So for that case, this is solution to question number 5A of November 2022 attention. Okay. So computation over here. Value of the forms are given. First, it asks about the equilibrium value for A and B in accordance with the approach, assuming taxes do not exist. So there is no taxation existing, and the equilibrium value of K is 9.09. So which is very simple enough. So K is given as 9.09%, right? And this K itself will be, KO for unlevered form is also going to be 9.09% only, right? And we say that KO for levered form is also going to be 9.09 because we know the K differs as per the risk, but the overall cost of capital will remain one and the same in the absence of any taxation. So we have EBIT figure for A and B. So EBIT for A is 5,000 and for B is also 5,000 because that's the net operating income. Then we have the KO, which is 9.09% in both cases. And since there are no taxes, value of both the companies, levered as well as unlevered, is going to be equal. So we say equilibrium value. Equilibrium value will be simply your EBIT divided by KO. 5 lakh divided by 9.09, which is 55,005. Okay, so that's the first part. Then compute the value of equity and cost of equity for both the forms. So we have to get the cost of equity and value of equity. So we get the equilibrium value for both of them. Now from that, we will reduce the value of debt. There exists debt only in the company B, which is 30,000. And then you have the value of equity. This is 55,005 and this is 25,005. Right, so value of equity, we get 55,005 and 25,005. So now based on this, we can say K. For that K, I need to get the amount of the debt also, or I can say the amount of the PAT. So for that purpose, we have the EBIT figure, which is equal for both, less interest. We will have interest only in the second case, which is 30,000 into the cost of debt. Now, if we look at the question, cost of debt is directly be given as 1,800. So we can simply say this to be 1,800. And then you have PBT as well as PAT. Both of them are same because there's no tax. So PBT or PAT is 5,000 and here it is 3,200. Correct? So we have K as 5,000 divided by 55,005. And this is 3,200 divided by 25,005. So we get the cost of equity here it to be 9.09% itself, whereas cost of equity in the levered form is simply going to be 3,200 divided by 25,005, which is 12.8%. Okay, so that's pretty simple. The question is comparatively easier. Yeah. Okay, that's the equilibrium price. Then one question that we had from here, it was in the ratio part. Yeah, this one. Following figures are related to the trading activities of M Limited. This is question number 1B, I suppose. Yeah. This is our solution to question 1B of November 2022. The following figures are related to the trading activities of M Limited. It has a total assets of 10 lakh. Debt to total assets is 50%. Out of total assets, 50% is funded by debt. It means the balance will be funded by equity. Yes, Himanshu, you're right. Equilibrium price means the value of both forms is equal. Interest cost is 10% per year. And we have the direct cost as 10 times of the interest cost. Operating expenses is 1 lakh. Goods are sold to customers at a margin of 50% on the direct cost. And tax rate is 30%. Tax rate is 30%. You have to compute these ratios. Okay, so let's go. Let's begin with this. Now, first of all, total assets was 10 lakh. So debt will be 10 lakh into 50%, which is 5 lakh. Okay, so that is 10 lakh into 50%. That works out to be 5 lakh. Then interest costs. Interest cost will be obviously on this 5 lakh portion. On this 5 lakh, the interest cost was 10%, which is 50,000. Also, direct cost as given in it, direct cost is 10 times of the interest cost. So it is 10 into 50,000, which is 5 lakh. That's the direct cost. Then you have the sales figure. For sales figure, we have this ratio of debt to total assets. Goods are sold to customers at a margin of 50% of the direct cost. At a margin of 50% to the direct cost. So direct cost is 5 lakh. So sales is supposed to be 50% of the direct cost, because they say it's going to be a margin of 50% on direct cost. So we can say it is 5 lakh plus 50% of 5 lakh. So that's like 7 lakh 50,000 sales. 7 lakh 50,000 sales. The sales is 7 lakh 50,000. And you get the GP as 7 lakh 50,000 minus 5 lakh, which is 2 lakh 50,000, right? And from that GP, you can subtract your operating expenses, because they have given us some amount of operating expenses also in the question, which you can see operating expenses 10,000. So I'm subtracting that, not 10,000, my bad. Operating expenses is 1 lakh, yeah. You get this as EBIT. and EBIT works out to be 1,50,000. From that 1 lakh, we will subtract the interest, which is 50,000. And then you have profit before tax to be 1 lakh. From that, we will reduce the tax at the rate of 30%, which is 30,000. And you get a PAT as 70,000. Okay, so after this income statement, let's try to answer each one of them. First up, net profit margin. Net profit margin will be 70,000 net profit divided by 7,50,000 sales. Right, 70,000 divided by 7,50,000 into 100, you can just say to convert it into percentage, which works out to be 9.33%. Then we have the next as a net operating profit margin. Net operating profit margin. So operating profit is basically your EBIT. So EBIT upon sales into 100. So EBIT is what we have computed to be 1,50,000. So 1,50,000 divided by sales of 7,50,000 into 100. So 1,50,000, which is 20% net operating profit margin. Then if we say this as return on assets, return on assets, you can say EBIT is something that is generated on the assets. So EBIT upon assets into 100. So what's the level of EBIT that we have? EBIT is 1,50,000 divided by 10 lakh. You have return on assets to be 15%. Right? Then the next ratio that the question has asked is return on equity. Return on equity. So what is the amount of owner's equity? Because you have the debt as 5 lakhs out of total assets. If debt is 5 lakh, the remaining 5 lakh is going to be equity. So on this equity of 5 lakh, you're having a return of which is PAT, right? So 70,000 divided by 5 lakh into 100, you can say that works out to be simply 14%. So again, a pretty simple. Didn't get the sales figure. Darshan, they have said that margin or the sale margin is 50% of the direct cost. So if your direct cost is 5 lakh, it means your profit on that is 50% of it. So which is like 2,50,000 is the profit against the direct cost. So direct cost of 5 lakh plus 2,50,000 of direct profit. So that gives you a sales of 7,50,000. Okay, Shubham. Yeah. Fine. So we have done this questions that we have in the November 22. There was a query about two formulae given on page 5.16. Okay, so let me just see which one are you talking of. Direct cost is same as COGS. You can say Darshan, direct cost is same as COGS. The return on assets we take, Himanshu, EBIT, because EBIT is something that you have generated on the total assets, right? Therefore, you consider that. Okay, so let me just go through that formula which has been highlighted by Himanshu. So Himanshu, where do we have that thing? Let me just have a look at it. Yeah, value material, intermediate, then then two, and then we have the risk analysis dividend on page number. What is the page number that you have stated? Page number 5.16. Okay. On page number 5.16. Yeah. Also theory, trade-off theory and pecking order theory. Yes, I'll be discussing that. Don't worry. Page 5.16. Come over there. Yeah. Well, guys, we have seen this formula. Value of a levered company will be value of unlevered plus tax benefit. Basically, value of a geared company value will be equal to value of ungeared company plus tax benefit. And we know that this tax benefit essentially is tax rate into the value of debt. It's a tax rate into the value of debt, right? Then cost of equity in a levered company is a new formula that we have. Cost of equity in a levered company. In case of a levered company, we can understand this formula in a very logical way. The expectation of equity shareholders in a levered company is going to be higher. So whatever is the cost of equity in a ungeared company, that is going to be earned by the equity shareholders levered company. Plus, they will also have something as a benefit from the debt, as a benefit from the debt. Okay. Now remember, cost of equity in case of geared company will be same as its overall cost of capital, will be same as its KO. Okay. So let's say if I tell you there is an ungeared company and there is a geared company. Okay. Cost of equity, and we also talk of debt and equity. Let's say ungeared company has got a cost of equity. Ungeared company has got a cost of equity as 15%. Since there is no cost of debt, there's no cost of debt. What about the overall cost of capital? Overall cost of capital will be also same 15%. It will be same 15%. Okay. And let's say debt equity ratio. Suppose you have one debt for every two equities. So these are the parameters for a ungeared company. So for an ungeared company, we have cost of equity as 15%, cost of debt is 0. So overall cost of capital will also remain 15%, and debt and equity are in the ratio of 1:2. Okay. So we want to know what will be the overall cost of capital and cost of equity and cost of debt over here. Now, suppose in case of geared company, we only have information that cost of debt is, sir, 10%. Cost of debt is 10%. So first up, I can get this KO into over here. This KO can be obtained by simply looking at the ungeared company KO. See, the ungeared company KO is 15%. So for geared company, the overall cost of capital for the geared company, the overall cost of capital can be computed by using this simple formula, which says that it is going to be 15% multiplied by 1 minus, let's say the tax rate is 30%, 30% into the leverage aspect. Leverage is basically debt upon debt plus equity. Yeah. So let's understand what does this mean. Let's try to understand it in a logical sense. Since there is a tax benefit enjoyed by the geared company because it has loan. The company which has a loan enjoys the tax benefit. So that tax benefit, is it available due to debt or is it available due to equity? The tax benefit is available due to debt or is it available due to equity? Tell me, guys. The tax benefit that a geared company has, is it due to debt or is it due to equity? Yeah, it is due to debt, right? So let's this company has got 1 rupee debt. This company has got a 1 rupee debt. So on this 1 rupee, the company is going to get 30% tax benefit out of it. So 30% tax benefit is going to be on this 30% is going to be tax benefit on this 1 rupee of debt. But this saving of debt, this saving of 30% will be shared by the entire funds. You have that benefit of 0.3 due to debt, but that benefit will be shared by all the fund providers, right? So basically 0.3 into 1 is the benefit that you will have. That divided by total capital, that divided by the total capital, this is what the total benefit the company is going to have, because here we are taking 15% to be the overall cost of capital. We're taking the 15% to be the overall cost of capital. So 0.3 into, when you do this is the total benefit that you have. 0.3 into 1, this is the tax benefit that you have. That tax benefit shared by all the fund providers. So this is the total benefit that you have. That benefit will be reduced from your overall cost of capital, which is 15%. So this 15%, 15% is on a total capital, right? 15% since it is KO, this is on total capital. From that total capital, you have to reduce the tax benefit. So tax benefit is how much, sir? Tax benefit is 30% of 1 rupee debt. But that 1 rupee debt, 30 paise of tax benefit that you have, that will be shared by all the fund providers. And that's where you have this 15% minus the tax benefit, or I can say the overall cost of capital. You can say 15% minus tax benefit. Now, minus tax benefit means 15% minus tax benefit into 15%, right? So it is 15% if you take common, 1 minus tax benefit, and then you have 15% into, how do you get the tax benefit? It will be 0.3 into 1 divided by 1 plus 2, because you get 30% tax benefit of 1 and then divide it by 3. It's the total tax benefit that you get as reduced by 15%. So once you solve it, you will get the answer as 0.3 divided by 3 minus 1. So into 0.15, which is 13.5%. So we get the overall cost of capital to be 13.5%. It means due to tax, there is a tax saving of 1.5%. But I can say your KO gets reduced by 1.5% because of the tax. So that's somewhat I've tried to explain you the logic for this. So the formula is like, 0.3, 30% of the debt divided by the total capital as reduced by the overall cost of capital. Did we get the KO logic? Did we get the KO logic? Is it clear? I've tried it to the best level possible to give you the most simplistic explanation for the SEM. It is simple. The tax benefit on the debt distributed amongst all the fund providers, and that benefit reduced from the 15%. So KO logic is clear. Now coming to K, cost of equity. Now this cost of equity is automatically a derived product of this, right? So it's just a derivation of it. We know, overall cost of capital. We know that overall cost of capital is weight of equity into cost of equity plus weight of debt into cost of debt. Weight of equity into cost of equity plus weight of debt into cost of debt, right? Now, KO, weight of equity will be equity upon equity plus debt, right? Into K plus weight of debt will be debt upon equity plus debt into cost of debt. Now we have derived a formula for KO, this one, right? So let's try to put it up. KO for the levered form, we got it as KO of unlevered form, just KO of unlevered form. This formula which we have used, KO of unlevered form, into 1 minus KO of unlevered form into 1 minus tax rate into debt upon debt plus equity. Right, so this is what we have used. We have just derived the KO formula. We have got the logic of KO over here. So just I wrote the KO of unlevered form, and this is obviously of a levered form. Right, so this is obviously of a levered form, and we can simply arrive at this. Now, we can do some sort of mathematical jugglery to work around this, and we can get this as KO of unlevered minus KO of unlevered into tax into debt upon debt plus equity is equal to equity into, equity upon equity plus debt K plus debt upon equity plus debt KD. Then multiply throughout by, this side we can take an LCM, and that essentially becomes debt plus equity into KO of unlevered minus KO of unlevered into T into debt upon debt plus equity is equal to earnings, E into K upon E plus D plus D into KD upon E plus D. Now you can do the cancellation of all three over here. Right? And once we have cancelled, I just want the K on one side and rest all on the other side. So let's try to put it up on the other side. So we can take K of unlevered on the other side. And what we will have is debt plus equity minus tax into debt rate. And this side you have equity into K plus debt into KD. So K of unlevered into debt plus equity minus tax into debt rate will be equal, or I can say tax rate into debt rate minus debt into KD will be equity into K. Right? So now from this, you can say KO of unlevered. Again, from here, you can take common debt. To take debt common, we have over here 1 plus equity minus T into debt. Or rather, we'll just have minus T because we're taking entire debt common minus debt into KD is equal to equity into K. So if you take K is equal to unlevered, the overall cost of capital, this divided by equity, and inside you have debt into 1 plus earnings minus T. And further from this minus D into KD. So if you just go ahead and try to solve it in mathematically, if you just solve it, you will get this form of equation where the cost of equity of the geared company will be cost of equity of ungeared, difference between both. And this is the benefit. This is like the equity shareholders are going to get excess return over and above the cost of debt. And that is on the amount of debt and divided by debt plus equity, which is attributable to entire company. Right. So that's why this is again a mathematical derivation of it, which I have not completed it because there's no proper spacing and all that, and it's not relevant for the exams also. You can just substitute this over here. Just substitute this over here, and you'll be able to get the answer by simple derivation. Okay, so there may be some sort of mathematical errors also possible over it. I'm not just going into details. Right now, let me just touch upon, because these are the mathematical derivations. So not going to detail. Now, let me touch upon something called as pecking order theory and a trade-off theory that we have. Yeah, let's look at this trade-off theory. See, the trade-off theory, Darshan is asking, sir, KE minus KD, is it like a risk premium? Yes, you can say it's a risk premium for the equity shareholders. You can say that, Darshan. Okay, so this trade-off theory now, based on the capital structure theories that we have learned, uh, it also favors that the value of unlevered firm, this one, is at one level. And if you go for increasing the value of your firm, if you want to raise the value of your firm, what are you supposed to do? You'll have to take advantage of financial leverage if it is in your favor. If financial leverage is in your favor, you should take advantage of it. How can I take advantage of it, sir? You could take a loan at a lower rate. I mean, your cost of debt should be less than your return on capital employed. If your cost of debt is less than a return on capital employed, then it makes sense for us to take a loan. If my cost of debt is, let's say, 8% and return on capital employed is, it's maybe just, let's say it's 15%. So if your business is earning 15% and you can get funds at 8%, it makes sense for me to get the funds at 8% and put it into the business, which gives me 15% return. So when it is in your favor, when your leverage is in your favor, you should take debt. And if you take debt, the value of the firm is going to increase a bit because of interest savings, because of tax savings on the interest. So because of tax savings on the interest, you are going to save money, and that will be leading to the increase in the value. So this x-axis indicates the level of debt. So as you take more level of debt, you have the present value of the interest tax shields. Okay. So when you have this present value of the interest tax shields, you are actually increasing your firm value by somewhat level. As compared to unlevered firm, levered firm is going to have a better value. But this you cannot continue forever. This aspect you cannot continue forever for a simple reason, guys. If you take more and more debt, after a point of time, it will hamper your liquidity, and there will be a fixed obligation to pay loan and the pay interest and principal things. So that is where the cost of financial distress comes in, right? So you'll find that the line, there is this, the value that will be added to your company value is the upper line, the lighter one. But you cannot attain that greater value line because there will be always that risk of financial distress or the cost of financial distress. So due to the cost of financial distress, you will not be able to attain the maximum value possible. Rather, your value will be a bit lower. And after a point of time, the cost of financial distress will be more than the benefit that you are deriving out of the leverage. And the value of the company will start falling. So in simple sense, if you don't take any loan, value of the company is constant over here. The value of an unlevered company is constant over here if you don't take any loan. If you take loan, then this is on the x-axis, by the way, you have the level of debt. So if you take loan, you'll find that the value of the firm will increase. Okay, so this is the value of levered, but you cannot attain that levered firm value because there is always this financial distress. And after a point of time, the financial distress will start eroding. This is your possible value of levered company, but what you can see as a green line is the actual value of the levered company. So the gap in between that you see, this is the cost of financial distress. This is the cost of taking more debt and facing the cash crunch in the form of due to regular interest payment or cash payments. Okay, so that's your trade-off theory. So it's a trade-off between the advantages and the cost. What is the advantage of taking debt? You get the tax benefit. What is the cost? Cost of financial distress. So tomorrow, if I'm not able to pay, there will be too much implication and I may be forced to liquidate my business. Right. So there are certain legal costs, indirect costs, cost of employee sacking and all those things. And those are the costs which are actually going to outweigh the tax benefits that you are getting as of now. So that's a trade-off between advantages and disadvantages of taking debt. Okay, that's your trade-off theory. Then pecking order theory. Pecking order theory says, or rather, this is a theory which is based on a survey which was undertaken amongst the finance managers And this theory simply states that the firm prefers to issue debt when they are positive about future earnings. Equity is issued when they are doubtful and internal finance is insufficient. So in a form that whenever a company wants to take up a new project, whenever a company wants to take up a new project in which they want to invest a substantial chunk of cash, uh, what they prefer is to first go for internal finance. The manager should always look for whether I can fund my project by way of internal sources. Internal sources means by way of reserves and surplus, by way of past profits. So we should look at whether we can fund the project by past profits. If past profits are insufficient, then you will go for debt financing. Because debt financing is seen as an indicator that the company is sure of obtaining some amount of cash flows. Company is sure of obtaining some amount of cash flows from the project, and that's where the company is going to issue debt. If the company is doubtful, then it will issue equity shares. So pecking order theory, this theory has actually stated, which has performed on the with a survey of finance managers. So finance managers were asked, what is your preferred source of funding? Which is your first preference for raising funds? Which is your second preference? Which is your third preference? So the results came out that majority of the fund managers, majority of the finance managers, they were of the view that first we should use the internally available sources, that is the reserves that we have. If that is insufficient, then you should go for a debt. If that is also insufficient, equity shares, it sends a signal to your equity shareholders that they are not essentially, confident. They're essentially not confident of getting the cash flows, and therefore they are issuing the equity. Okay, so that's the order of issuing shares which have been put up by the pecking order theory. Right. So these are the two theories that we have. I hope that both the theories are clear to you. Is it clear, guys? Pecking order and the trade-off theory. Are we good with it? The pecking order and the trade-off theory, guys. Yeah, understood. These are a bit modern theories as compared to our net income and net operating income approach. Okay, net income and net operating income. They are a bit of modernized theories that we have. Now, let's go for finally one question that we will solve from RTP of November 22. Clear? You can just try out these questions from the November 22 RTP for this questions on ratio analysis. You can also work out with the question from the capital structure also. Anyways, you can. I'm just looking for some smaller question that we can probably try to solve it. Yeah, this seems to be a good question. Try out this question, guys. And for this, it is clearly stated what all you need to calculate. You need to calculate the sales, cost of goods sold, sundry debtors, right? So try to solve them within a stipulated time of, let's say, I can give you time of exact 7 minutes. So your time starts now, guys. Come on. Try to solve it within a span of 7 minutes. Yeah. Quick, guys. Can find the solution to this also. Try to solve it. Pretty easy. Just a hint for you. You can begin with the gross profit and the GP ratio. So that will give you a sales and COGS. Accordingly, you can go ahead with sundry debtors, closing stock, creditors, and fixed assets accordingly. Once you get the sales and COGS, you should be able to crack everything else in the question. Okay, 2 minutes down, 5 more minutes left for you guys. I think you should be able to get the COGS pretty easily. So you can get it easily. 12 lakh divided by GP ratio is 25%. So 12 divided by 25% should be your sales figure. Which is 48 lakhs should be your sales. And from that, if you subtract 12, your COGS is 36 lakh. Sundry debtors. 3 months is the debtors, so that should be 36 lakh. No, not 36, 48 lakhs into 3 by 12. 48 into 3 divided by 12. Which comes out to be 12 lakh sundry debtors. Then closing stock, you can take help of COGS. So for COGS, you will take 36 lakh into 1.5 times. So stock turnover on the basis of COGS is 1.5 times. Divided by 1.5. 36 divided by 1.5. Which is 36 divided by 1.5, which is 24 lakhs. 24 lakh is the average stock. Accordingly, you can get the opening and closing figures. Creditors, for that, you need to compute the purchases, and for fixed assets, you can use the fixed asset turnover ratio. Just verify the answers. Yeah. We got the COGS, we get the debtors as 12 lakh. So we get a opening and closing, and then you have 24 lakh 15. Debtors should work out. Creditors should be 575. Fixed assets should be 9 lakh. So it's a pretty easy question to be solved within 5 minutes. So you can just try out the other questions from the past RTP and MTPs just for your practice. Till that time, we'll just call it a day right now. So let's just stop here for the day, guys. See you in the next class. That's probably going to be the last class of mine. That is tomorrow, which will be taking up the last topic, which is leverage. Okay, so let's stop here for the day, guys. See you in the next class. Bye bye and take care.